Hey everybody, this is Ray Halstead and Andrew McMillan with REH CPA. Today we want to talk about cancellation of debt income and how it affects your taxes. You know, sometimes when we go through periods like a recession or an economic downturn, individuals sometimes have a hard time paying their debts, like their mortgage or credit cards. And sometimes they're able to work it out with the lender to where they don't have to repay those debts. Well, when that happens, the lender will usually issue what's called 1099-C, and that's a cancellation of debt income. Now, this can be a very complex area, so I've got Andrew McMillan here with me to talk about, how that 1099-C cancellation of debt income could potentially affect your taxes. Andrew, can you give us some more information on that?
Yeah, sure. So if you have a debt that's canceled, you're going to get a 1099-C like you alluded to, and by default the IRS is going to treat that as taxable. It's almost always taxable when you get a 1099-C. But there are a few exceptions to that general rule where you can actually shield that away from income, exclude that from your income. One exception that we see a lot is in a bankruptcy. So if you're going through bankruptcy, oftentimes some debts get discharged or reduced, forgiven. So if you're going through a Title 11 bankruptcy, then you can exclude those debts from income in a situation like that. Another one that we see a lot is insolvency. So if you are an insolvent taxpayer, the amount that you're insolvent, you can use that amount to reduce the amount of debt that was canceled. So when we talk about insolvency for a taxpayer, you're really talking about, what are their assets? What are all of your assets compared to your liabilities? So the amount that your liabilities are above your assets, whatever that amount is, your liabilities less your assets, whatever that amount is, that's how much you can use to reduce that 1099.
So if you have like $100,000 in assets, but say they're only worth $100,000, but you have $200,000 in debt, then your insolvency is that $100,000.
It is that $100,000. So if you had a $200,000 debt forgiven, well, then you can exclude $100,000 of that from taxable income. So
gotcha. So when we're looking at assets and liabilities, what kind of assets are we talking about?
Sure, yeah. So we're really talking about anything that you have that's a value personally. So we're looking at people's cars, their homes, expensive jewelry you may have, furniture, things like any assets that you have, whatever the fair market value of those are, that's what you have to figure up. And then you're looking at all of your debts, really everything that you have an obligation to repay. So your mortgage, car loans, credit card debt, any other bank loans you may have, home equity line of credits, things like that. You've got to figure out what that calculation is for yourself to figure out how much you're insolvent by.
And it's as of the day before the insolvency.
It is.
Before the cancellation.
Yes.
So you get to include that in the calculation. You don't
do.
exclude it.
Yeah, that's a really good point. When you're figuring out how much you're insolvent, you do it on the day right before the debt was canceled. So you do get to include that debt that's about to be forgiven in your insolvency calculation. So that's usually helpful for taxpayers.
Awesome. So again, really complex area. We couldn't cover everything today because that would be like a 20-minute video. But if you received a 1099-C cancellation of debt and you want to understand how that affects your taxes, feel free to give us a call and we'll help you out. I appreciate it. Thanks.